Financials plummet, down 1.93% this week, as bearish trends intensify, with the relative strength index at 62, signaling a critical risk catalyst is looming. This is what every serious investor needs to know about financials right now. Stay with me. Welcome back, or welcome if you are new to Financial Market Oracle. This week, we find ourselves in a state of normal conditions, with the VIX at 19.2, indicating a relatively calm market environment. In this context, the financials sector is worthy of our attention, particularly given its recent performance. As of now, financials is slightly underperforming the S&P 500, and the sector ETF, XLF, has seen a decline of 1.93%. Despite this short-term dip, the financial sector remains a crucial component of the broader market, and its trends can have significant implications for investors. With interest rates and regulatory changes continuing to shape the landscape, it is essential to stay informed about the sector's dynamics. As we delve into the world of banking, insurance, and other financial services, we will explore the underlying factors driving the sector's performance. Please remember, this is educational content and not financial advice. Let us start with the technical picture and what the charts are telling us. The financial sector, as represented by the XLF ETF, has experienced a weekly decline of 1.93%, while still maintaining a monthly gain of 4.22%. The Relative Strength Index, or RSI, is currently at 62, which implies that the sector is approaching overbought territory, thus the bearish signal. This RSI reading suggests that the momentum may be waning, and a potential consolidation or pullback could be on the horizon. The trend direction still appears to be upward, but conviction is beginning to falter. Key support levels likely exist at previous breakout points, while resistance levels are at recent highs. The current move does not appear to be a sustainable breakout, rather an extended overreach, which could lead to a near-term correction. This week, we will be watching for a potential technical setup, where the sector may attempt to retest recent support levels, potentially leading to a consolidation phase. The key will be to see if the sector can hold above these support levels, or if a more significant pullback is in store. Now let us look at the fundamental catalysts driving this sector. The financial sector is poised for an interesting week, with several key economic events on the horizon, including the GDP advance estimate for the first quarter of 2026, PCE inflation data, non-farm payrolls, and the highly anticipated FOMC rate decision. These events will likely have a significant impact on the sector, which includes banks, insurance companies, asset managers, and fintech firms. Key stocks such as JPM, BCGS, WFC, and Berkshire Hathaway New are signaling a relatively healthy sector, with some potential for upside. Earnings reports from major banks will provide further insight into the sector's health, with investors watching closely for any signs of weakness or strength. Regulatory news is also a factor, as any changes to financial regulations could impact the sector's profitability. In terms of macro data, the GDP advance estimate and non-farm payrolls will be closely watched, as they will provide insight into the overall health of the economy. The longer-term fundamental thesis for being positioned in the financial sector remains intact, driven by solid economic growth, a favorable interest rate environment, and a strong banking system. With the VIX at 19.2, market conditions are relatively normal, which should support the sector. Please remember that this is educational content and not financial advice. Next, let us talk about the specific risks you need to manage this week. The financial sector is facing several key risks this week, primarily centered around regulatory changes, rising interest rates, and potential credit deterioration. Given the current volatility environment, with the VIX at 19.2, investors should be cautious with position sizing, as even a modest increase in volatility could lead to significant losses. Unexpected headwinds, such as a surprise rate hike or geopolitical tensions, could further exacerbate these risks. To manage downside exposure, a disciplined framework is essential, including stop-loss orders, diversification, and a clear understanding of risk tolerance. By acknowledging these potential risks and taking proactive steps to mitigate them, investors can better navigate the complexities of the financial sector. This is educational content and not financial advice, so it is crucial for investors to conduct their own research and consider their individual circumstances. And now for the strategic outlook, where does financials stand heading into next week? We remain cautiously bullish on financials this week, given stabilizing interest rates and improving sentiment. A key theme to track is the impact of monetary policy on bank margins. Remember, this is educational content and not financial advice. If you found this video insightful, please like, subscribe to Financial Market Oracle, and comment your financials watch list below. Until next week, stay informed, stay disciplined, and stay profitable. Cheers! This video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research before making any investment decisions. Past performance is not indicative of future results.